Hi there. I'm Ron Sneller, owner and founder of Sneller Financial Services, and I am thrilled that you're here with me today. It's been a long day, a very rewarding day here at the office. It's dark outside, but my goal was to get this next video done for the YouTube channel and the website. So here we are. I wanted to discuss a case study, which is bringing together all of the concepts that we've discussed up until this point. So the don't worry, retire happy process is this. Step one, work with the retirement specialist to develop a plan. Step two, maximize Social Security benefits. Step three, consider a hybrid retirement. Step four, optimize your investment portfolio to guard against inflation. And then step five was to secure enough guaranteed lifetime income to cover your paychecks and also your paychecks. So let's look at a hypothetical case study where we're going to bring all of these elements together. So I want you to meet my friend, Joe. Joe is a 65-year-old retiree. Joe has a small pension of $1,000 a month, Social Security of $2,000 per month, and $1 million in his IRA. Joe's goal is to maximize his retirement and spend his money in the most efficient way, but also in a way that will protect him against the key retirement risks. Step one is simply assessing his basic expenses. After a conversation with Joe, we figured out that his total came out to about $65,000 of income per year. That's what he would need to cover his basic expenses. And he wants to cover those expenses with guaranteed lifetime income. So he'll never have to worry about paying his bills no matter what happens and no matter how long he lives. So how do we go about solving this problem? Well, first of all, we know that there are $65,000 of basic living expenses that we need to meet. We apply his guaranteed lifetime income sources first. We have $24,000 of Social Security. We have $12,000 of his pension. And we see that we have a $29,000 shortfall to meet his basic expenses. Now, on top of that, we have a shortfall of $25,000 that he wants earmarked for discretionary expenses. That's the paycheck. But that comes later. What we have to do right now is we need to address the shortfall for his basic living expenses. That $29,000 shortfall, that's going to have to come from his retirement savings. Joe has $1 million in his IRA. So what is the best way to provide for his basic living expenses each month? Should it be money in the bank, like maybe a CD or a money market fund? Maybe, but the interest rate and the growth potential on those are so low that they're not even enough to keep up with the cost of inflation. What about using the stock market, or even a diversified portfolio, stocks, bonds, mutual funds? Well, here's the thing. We're trying to meet Joe's basic income needs. And so what we don't want are any products that are subject to volatility, where he might feel nervous about drawing out of a depleted retirement account during a bear market. Sequence of returns risk and locking in his losses and all of those other things that we talked about in a previous video. So what retirees need much more than those products and strategies that I just discussed are guaranteed income sources that they can rely on each and every month. Look, I've already mentioned that Joe has a pension and that he has Social Security, but it's quite possible that you, like Joe, are going to need a third source of income to cover all of your costs. So how do we do it? Well, here's what we do. We need to fill in any shortfalls with a lifetime income annuity from a financially strong insurance company. So in Joe's case, you will see to the left, he takes about $300,000 from his assets and he purchases the rest of his guaranteed lifetime income needs. So he's utilizing about 30% of his overall assets to secure his income floor. So this strategy will guarantee you steady paychecks, consistent, reliable for the rest of your life. No matter how long you live, no matter what happens with the economy, with the stock market, with civil unrest, World War III breaks out, God forbid, right? But this is the optimal way to do it. No matter what happens, you are covered. This is the happy factor. This is the secure factor. And as discussed in another video, the payout efficiency, it's much more efficient than any other method. So you have guaranteed paychecks in retirement, now covering all of your basic expenses. Now what? Well, now we invest the rest of the money by designing and optimizing a discretionary retirement portfolio. So what we do is we want to have the rest of the money, which is really most of our money, invested to combat the effects of inflation. Well, how do we go about doing this? Look, we have Social Security, we have pension, we have the income annuity. All the basic living expenses are now met. We utilized about 30% of Joe's IRA to meet that income floor. Now we have about $700,000 left, and we have to find the best way to invest it. So how does Joe do that? Well, first of all, you obviously want to work with a trusted fiduciary investment advisor representative. A representative like myself, we can utilize useful planning tools, whether it's created by Ibbotson or the different advisory firms have different tools that they use. Regardless of what tool that you use, each client completes a short questionnaire to identify their priorities, their retirement, their needs, their goals, and their specific tolerance for risk and volatility. Now, in Joe's case, again, this is hypothetical, but based on his unique criteria, the asset allocation model is going to produce a recommendation of how to optimize his portfolio to best meet his needs. So here's a sample portfolio and retirement plan here. Now, I know that as soon as this screen pops up, it's like, whoa, that's busy. There's a lot going on this screen. And I get it. Thanks for sticking in there with me. I'll simplify this and make it as easy as possible. Remember, our income floor is already covered through the pension, through the Social Security, and through the income annuity. Now this is about investment growth. So we bought our income and now we're investing the rest. So I want to draw your attention to the pie chart. This is Joe's asset allocation model for his discretionary assets. And so again, this is just based on him. This is a hypothetical example. This is not based on you. Your model might produce a different allocation, but this is pretty common. So in traditional assets, Joe has 80%, and you're going to see that he uses the final 20% to buy more guaranteed lifetime income. Well, can you do that? Yeah, you can. And I'll explain that in just a minute. But let's talk about his traditional assets. So based on Joe's model, he has U.S. domestic stocks, 44%, international stocks, 16%, bonds, 17%, cash and cash equivalents, 3%. Now, why would he put more money into an income annuity? Well, again, remember, this is about discretionary spending at this point with this part of the income annuity. Because an income annuity has a stated payout rate and no market volatility, using this type of product in this situation does two things. Number one, it ensures that at least some of Joe's discretionary income will be guaranteed, so he can actually enjoy his retirement over and above his basic living expenses. But if all of the basic living expenses are met, the paycheck, and at least some or most of the discretionary income is taken care of, that being the paycheck, guess what? Again, depending on your specific risk tolerance and your time horizon, but with the rest of that money, that other 80%, you can invest it even more aggressively for growth. Why? Because if you were to experience some near-term volatility, like if the market were to crash within your first couple of years of retirement, it's not going to affect you. Why? Because all of your basic living expenses are met through guaranteed income sources that are not tied to any kind of volatility in the markets. You even have some discretionary income that's not tied to any of market volatility. So you know what that does? That allows you to just wait, to just relax, to take the emotional, behavioral decision-making out of the equation and let your investments recover and come back. Because with this money, we're in it for the long term. If we have a stock market crash 2 years into retirement, and if it takes 3 years to recover, no sweat. 5 years down the road, we're back to where we started. And over time, the stock market has seen growth. And then maybe 8 years down the road, 10 years down the road, 12 years down the road, when that money has greatly increased in value due to market appreciation, you know what we do? We peel off some of those profits and we use it to buy more guaranteed lifetime income. Why? Well, look, we know that inflation is working against us during that time. And if inflation is, let's say, 3%, in the stock market over a 10 or 12-year period, a good portfolio, invested stocks, bonds, mutual funds, it should outpace that rate of inflation. So not only are you outpacing the rate of inflation, you're making money, you're keeping your income needs where they need to be, but you're actually still growing money for the future. Whether it's maybe you have some kind of expense in mind, maybe you're going to go, buy a condo in Florida if your investments work out great. More likely, you're probably thinking about leaving a legacy to your children or to your grandchildren or to charity. But this plan has now taken care of just about all of these top retiree risks. The income annuity has taken care of longevity risk and deflation risk. Excuse me. Lifetime income annuities do very well during periods of deflation, because when we see periods of deflation, that is prices declining. But guess what? Your income annuity is right here, and the income doesn't decline. So during periods of recession, when we see deflation, your income annuity actually increases in purchasing power. We've also managed market risk and sequence of return risk, because income annuities are not tied to the market. We've managed withdrawal rate risk because the income annuity lasts as long as you live. But the important thing in this part of the strategy is we've also optimized our investment portfolio for growth to protect against inflation. We have liquidity. We have our legacy planning goals. And really, the major thing that we haven't addressed yet is the long-term care risk and medical costs. And we'll address that in the next video. But I hope that this video was helpful to show you how most of these pieces here, between the guaranteed income sources, the Social Security, the annuities, and the investments, how it all comes together. It works together as a puzzle. But again, that's why you really need professional assistance to help put that puzzle together. Not only can a financial consultant help put together the plan, they can help to coach you and guide you along the way, help you stick to the course for more retirement happiness, more security, and improved long-term outcomes. So, some standard disclaimers to wrap up this video. Just like every video in the series does, these concepts and educational principles are brought to you by Tom Hegna's Don't Worry, Retire Happy book and television series. Again, the information provided is not to be construed as specific investment advice, and I am not an attorney. I am not a CPA. So when it comes to tax and legal matters, make sure that you are hiring the correctly licensed financial professional in those areas. Let's throw up our disclaimer about the registered investment advisory firm that I work with, as well as the insurance companies that we place the annuity and insurance business through. And finally, just like always, all of the examples shown are hypothetical. Joe's investment portfolio, that's not going to be your investment portfolio necessarily. We talk about annuities. We talk about rates of return on the portfolio. Look, these rates can and do change often. They can depend on your age, your health, your gender, your longevity, your tolerance for risk and for volatility. Make sure that you are working with a trusted financial professional so that your plan and your investment portfolio is built to meet your goals and your needs. I would love to help you do that. My phone number and my email address is on your screen. At the end of the day, my job is to help you reach your goals. And if you're still watching this video series, your goal is, don't worry, retire happy. That's our motto, and I'm happy that you tuned in.